Now that brings us to our week-long series on investing. Tonight we're comparing exchange-traded funds, or ETFs, and index funds. Exchange-traded funds began trading more than 15 years ago, but in recent years they've been gaining in popularity against more traditional mutual funds. Now, to better understand ETFs, I turned to Doug Flynn, co-founder of Flynn Zito Capital Management, and I started by asking him to explain the difference between an ETF and a mutual fund.
Well, an ETF is essentially a mutual fund that you know and love, a regular traditional mutual fund, but it trades on the exchange, so you can buy it throughout the day. So it's still a basket of individual securities, whether they're stocks or bonds, but it's traded on the market throughout the day, and that's really the difference versus a traditional fund which trades once a day at the end of the day.
Okay, so let's talk about index funds, which are really, they came first, right? First you had stocks. Then you had index funds.
Yes, and an index fund is simply trying to replicate a particular index, which you can invest in directly, but this is a way to replicate that. So if you like the stocks in the S&P 500 or the stocks in the Dow, or
it used to be that you could just read what happened to the stocks in the Dow or the S&P 500. You could buy the individual stocks if you wanted to. You could buy all 30 in the Dow.
That's right.
But then we came up with index funds, which said you can do the Dow, you can do the S&P 500, you can do NASDAQ, you can do, I don't know, Eastern European, industries.
Exactly. And that is going to track an index. There isn't a lot of trading or active management in there. There isn't any. It's essentially saying if the Dow kicks out a stock and brings in another one, well, that will happen in the index fund to follow. But it just follows whatever that particular index is. But it's a bunch of people sitting around saying, I want to knock this stock out and bring this one in. Same thing with the S&P 500. You would think it's the 500 largest companies all the time, but there's There's some movement that stocks have to get entered into it and then taken out accordingly. Right. There's mergers and whatnot. So there's something going on in there. But you're buying an index that's saying I'm going to replicate the market in that way, and it's a very inexpensive way to do that. And you can do that in a traditional mutual fund format or in an ETF, which is the exchange-traded version of that, which just means it trades throughout the day.
Generally speaking, index brought the management fees, these fees associated with mutual funds, down.
Yes.
Because there isn't somebody doing a lot of active work.
That's right.
And ETFs brought them down further.
Correct.
So why would I choose one versus the other?
So if you buy an ETF, you're typically placing a trade like a stock. So if you're with an online broker, they're typically going to charge you some kind of a trading fee to do that, where a mutual fund might have a minimum, but it doesn't have necessarily a transaction charge to do that. There are some cases where that isn't the case, but let's say
if you're doing it for fees, then you better look at this and understand how much you pay for trades.
Most people are putting money away each month. $100 a month is what they're doing. You can't really do that with an ETF because you're making a transaction every single time. That's where a mutual fund might be better.
Right.
But once
if you're putting $100 a month away and you're paying $10 for the trade,
you've got to weigh that in.
Maybe
you use the index fund for a little while, and then you have $10,000, and now you can actually do those transactions one-off here and there. So that's where you might want it in different ways, and so therefore it's cheaper. Like anything else, the more money you have, when you do that, it could be a little bit less expensive.
One thing you warn is that not all ETFs are created equal. What do you mean by that?
Well, as an example, there are the two major providers. There's Vanguard, there's iShares, which are two different providers of ETFs, and you have to look at the structure. And the structure of iShares in particular is they're completely separate, which means that their tax ramifications are very low. They don't necessarily pay capital gains to speak of because they're just trading in and out within the ETF structure by itself. It's a standalone ETF. Vanguard did what was called sort of a bolt-on to its existing mutual funds. And what's happened there is that in some cases, when the fund pays a capital gain distribution,
because they sold a stock at a profit.
Right. A large institution wants to sell a bunch of their fund, it transfers into the ETF itself. So all ETFs are not created equal, and you should look at, if I want bond index ETFs, look a little bit deeper and see where there are capital gains distributions. Many people know that there are these issues in traditional mutual funds that are actively managed.
But they don't think about it in index.
They don't, and they don't drill down and say, are there differences between the different ETF providers? There are other ETF providers as well.
And of course, that makes a difference depending on how you're investing, whether this is inside a tax preferred investment or it's just out in the open.
If it's an IRA, it doesn't really matter, but if it's in a taxable account, the last thing you want is further surprises taxable that you thought you were avoiding by being in an ETF format.
This is a business for people who feel they're not going to outperform the market with their own selections.
Exactly. You've said, in a particular area, I don't think I can bring value. I can't find a manager that's going to bring value in a particular area, so I'm just going to index that area. And as a portfolio manager and as people who manage money, there are times that we find that you can't bring value with managers and they're out of favor, and so you might index more, but we're agnostic. There are times when there are people absolutely that can bring value and do. And so we don't have a preference or one way or the other. It's just what's going to bring the most value in the end. And there are times when indexing makes sense, and there are times when active management makes sense. But indexing is the cheapest and easiest way to just at least get that exposure, and you're not going to underperform by a manager's mistake. But the trade-off is that you're not going to outperform,
right.
And that's where people like to outperform if they can.
Well, maybe sometime you'll come back and we'll talk about how you can build a portfolio out of indexes and mutual funds, and maybe see if you can outperform. Doug, good to see you as always. Doug Flynn is a co-founder of Flynn Zito Capital Management.